Welcome to Money Hangout once again. Every week we talk about an issue you are concerned about and we take your questions. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about one subject, one issue, one investment issue about which you are very anxious. Recently, you have faced losses, and all investors are uh, too anxious about this. That is the time for debt funds over? Are the best times gone? Uh, Last month, a few weeks back, Reserve Bank in its monetary policy said that no more rate cuts and unlikely to be so. This was actually the summary of the monetary policy statement. And every mutual fund was very differently positioned. Every mutual fund manager was expecting that there will be a rate cut. If not very, the quantum might vary, but that was the expectation consensus of the expectation. And it did not happen. Every fund actually took a hit, barring the liquid funds. Every mutual fund, every fixed income category did take a hit of, ranging between anywhere between 0.5% to 3 to 4%, 0.5 to 4%. And all investors who invested in these debt funds not very long back, in the last 2 3 months, or even few weeks before this rate cut, they were in for a surprise. And understandable that we invest in fixed income not to lose money. The fixed income investment is primarily for capital preservation. So these are, and I think it has changed what we have seen. So the key thing is that the best times might be over. What we have seen so far, 15% return from these bond funds over the last 3 4 years, from the gilt funds, from the dynamic bond fund, that may not happen in the future. But that doesn't mean that you should not have fixed income fund. Fixed income has a role in your portfolio. And even despite the 3 4% decline, one has to understand that fixed income funds, which invest primarily in bonds, are rooted in reality. There are only three things which concerns, three things which has a very clear role. Unlike equity, where it is all up in the air. If a company is good, and if the company is likely to grow rapidly, and it will keep doing, and all the variables that contribute to a company doing well, uh, they are unpredictable. It is dependent on the environment, it is dependent on the management, it is dependent on the sector it is in, it is dependent on many other things. It is dependent on the government, it is dependent on, so anything can actually affect. We have seen it in the past that a company's performance is heavily dependent on just too many factors to guess. Broadly, you can try and guess about, and that too roughly. You can take some comfort from its past performance and then roughly guess about what it is likely to do. Debt is not like that. It is rooted in reality. How good is the company, and not in terms of how well it will do. Primarily, a fixed income, a bond investor's objective is very narrow. Will this company be able to pay me interest on time, and will the company pay back my money? If these two things are very nicely in place, the company gets a AAA. And so in that sense, we have a very narrow focus as a fixed income investor on a company. Then the other two variables which determines the price of a bond is how long the maturity, how far off is the maturity of the bond, and how often I will get the money, and how much. What is the coupon of the bond, and how coupon meaning the interest payable by the bond, and at what frequency. So return, time frame, and the quality. These two things and these three variables are reasonably predictable. That is why fixed income funds, which invest in these bonds, are rooted in reality. That is why they are considered as a capital vehicle of capital preservation and modest return, not extraordinary return. And that is what you should look at. And this is time to remind yourself that that is all there to it. Expect moderate return from fixed income funds, and you'll be happy to get, and the two benefits of investing in these bond funds is pretty straightforward. You get marginally higher return than the alternative of fixed deposit, and the tax treatment is better if you hold it for a longer period, and longer period meaning 3 years and more. because that is when your interest income kind of income becomes a capital gains. So these are the two things which you should look at, and of course superior liquidity. Uh, so if you should invest in fixed income fund primarily for this, and that it offers you reasonable flexibility. There are two, three things, one particular thing which you should not look at bond funds, which investors in the last 2, 3 years started looking at, is decent capital appreciation. While the market was volatile, bond funds were going only one way, that was up, and decent return, 14-15% return in the last 3 years. So look at it, look at it happily, fondly as the past, and reconcile with this change. Now, what happens, one of the concerns people have, and that is basically a behavioral thing, that you invested in a bond fund, and you invested in a bond fund, and you are faced with a 3 to 4% loss. How long will it take for you to recover this money? I think it will take anywhere between 3 to 6 months. And look at the impairment. Even a 3% decline for anybody who has invested in these funds 1 year and more, I don't think they have much to worry. Your 15% return now looks like 12% return, or your 14% return looks 11% return, which is not all that bad. Just that we are not used to, and that is not our generally the expectation from such a fund, so we are a little disappointed. That's one. The other reason why we invest in bond fund is to either it is a rebalancing allocation. When you have otherwise a equity portfolio or a long-term portfolio, you want to moderate the risk by investing a part of it in fixed income. Alternatively, it's the other way around. You are dominantly invested in fixed income, and you invest a part of it in equity to protect the capital worth of your capital. And for both these reasons, I think you don't have a way around fixed income funds. You have to invest in fixed income fund for the capital to be rated, for a reasonable part of your portfolio from which you want to derive income, or you want to reduce the risk of your otherwise a growth portfolio. Now, how to reduce your risk? I think there are 2, 3 things which you should keep in mind. One is the perfect matching of your goals, your investment time frame, for with the right kind of fund. Investing for few days, consider a liquid fund. Liquid funds have improved substantially. If you look at Birla app, the active Birla active, that you can invest in a liquid fund, get your money back hit your account after your redemption request in a very short while. So that actually provides a great convenience. So money for few days, even a couple of weeks, consider a liquid fund. You will be able to enhance your return by compared to a savings bank account substantially. Then comes, and in that substantially is 1.5 times, sometimes twice as much. And money on demand. That is quite interesting. Then money for few weeks, ultra short-term bond fund. Few months, short-term bond fund. Maybe the time for dynamic bond fund and the long-term gilt fund might be over. And if you're willing to assume some risk, consider you can look at the credit opportunity fund, but I would say that conservative investor can do without any of those. If you are a long-term fixed income investors, maybe these are interesting times for the fixed maturity plans. Rate cuts will not happen, though these funds, the open-end dynamic bond fund and the other kind of funds, they are unlikely to see that kind of appreciation that we have seen in the past. So you can lock into the higher rates, get a predictable return, not look at the values in between because it doesn't matter. It's a closed-end fund you will get the indexation benefit. So long-term fixed income investor should start actively looking at FMP as compared to the open-end bond funds, which we have been used to. Once you do this, I think you will not be in for surprises. And eliminating surprises is the primary goal of an investor when investing in a fixed income fund. So simple things to do. And if you have a large sum of money, large sum of lifetime accumulation which is invested in fixed income fund, because you are risk averse, you don't want to take chances, you don't want to allocate sizable thing to equity. Though I would urge that long-term money should be equity, but for some reason you want to keep it in fixed income, diversify. Don't be dependent on just one fund. Invest in 2, 3 funds so that you are able to split the risk. Any return enhancement will come only by assuming some risk, whether it comes by way of credit risk, whether it comes by way of taking an interest rate risk, which is longer maturity, anticipating a rate cut, or take forming a view on this, or a liquidity risk. If you are going to compromise on any of this will only enhance return. Spreading it across 2-3 funds will reduce your risk, and you will not be overly dependent on accident hitting one fund. So these are simple things to do. Match your investment time frame with the right kind of fund. Spread your risk and lower your expectation. Good times might be over.